Okay, my name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares Exchange Traded Funds. We're a provider of unique differentiated exposures around China's new economy sectors, as well as providing exposure to China's onshore capital markets as they open up and are made accessible to foreign investors for the first time. Well, I think early on it was always about education, how ETFs work, and I think it's that we're in an area where it's generally accepted, the kind of ETF 101. I do believe there's much further to go in our business around, as much as there's a knowledge base of ETFs, I think a lot about index methodologies that dictate how those ETFs invest. And there I believe that there's been not as much work done in understanding, why is Tesla not in the S&P 500? Why is Snap not in any index? Why does one emerging market index consider South Korea developed and one not and has it in emerging markets? Why is Amazon a software company as opposed to consumer discretionary? It's a technology stock. So I think as much as there's been a great adoption of ETFs around all of the positive attributes that make ETFs great, transparency, tax efficiency, low cost, intraday trading, I think we're still very early in the knowledge base of the index methodologies that dictate how those ETFs operate and what they own and what they don't own. We listed our MSCI China ETF almost 4 years ago in anticipation of what we felt would be become a very, very impactful event for all global investors. Whether or not they buy our ETFs or not, you're going to have a considerable more China in your portfolio over the next decade. And China will go from 28% today within MSCI emerging markets to over 40% with the full inclusion of Chinese A shares. And then with the potential for a South Korea and or Taiwan upgrade, China could be 50–60% within decades. So ultimately, for us, it was a huge validation, as well as we don't sit around and congratulate ourselves, but we've been preparing for this for quite some time, and certainly we hope to help educate investors as they think about what this inclusion means for their investments and their end clients. Well, I do think the business will continue to evolve and continue to innovate. I think we've seen more recently this movement to low cost is the solution. And I don't think the best idea our industry can come up with is cut the fee. I think there's opportunities to continue to innovate, opportunities to examine these index methodologies and create differentiated products. And differentiated products produce differentiated results. And at the same time, I think the emphasis on education will continue. It'll continue to evolve maybe away from ETF 101 to this evolution around index methodologies and how important, how mission critical they are in the operation of ETFs and the exposures they provide investors. One aspect around ETFs and their growth has been we've had since March of 2009 a 45-degree U.S. bull market where if you've diversified beyond the S&P 500, you've underperformed. If you've been anything but fully invested, you've underperformed. And that is an unusual situation. And I think if that trend were to persist, you would see continued further capitulation amongst active managers and that money being redistributed back into the 500 largest stocks in the U.S. And you have this almost self-fulfilling prophecy. So I think if that were to play out, it might not actually be necessarily a good thing, and we're potentially overdue for a rebalancing, maybe away from U.S. equities into other markets, particularly emerging markets.